We are going to continue with Unit 5.6, and we are going to go to the second slide of objectives, where you will see there are a lot of calculations. And this is interesting because you have to be able to understand what all of these mean to the AO2 level, but also to be able to calculate them. The thing that is not quite understandable to a lot of us is some are on the formula sheet, some are not. And so this is one of those things where you're going to have to understand what these terms mean, but also some of them you're going to have to be able to calculate without having on the formula sheet. So today we will talk about what goes into these, how to calculate them, but also what these mean. We will also look at cost to make or cost to buy, also not on the formula sheet, a really common IB question. We'll be practicing all of these in the classroom. This is pretty intuitive. It's looking at insourcing versus outsourcing. And so to get to the slides, you can just click on this link right here that'll take you to slide 27, which goes straight to capacity utilization. This is a really good formula to know and a term to use. This really looks at how much of the business's maximum capacity they're actually using. And so when I say capacity, it means how much for my total amount that I can either produce, maximum output, or potential like to fill seats or fill a plane. So this looks at what percentage we are using versus not using. And so there's a term you're going to want to know called productive capacity. Productive capacity is maximum level of output. So think about productive capacity as if you're looking at a movie theater, that every seat is filled. Or if you're looking at an airplane, every seat is filled. And so if, for example, a business has 80% capacity utilization, they're using 80% of that productive capacity, 20% spare capacity in the organization. So here is the formula. It's given to you, but there is a little bit of a area where you could get confused because you have to know the term productive capacity to know what goes into it. So for capacity utilization, you will take your actual output of the business, divide it by what the maximum output is, which is known as productive capacity, and then multiply that by 100. So if we have maximum output of 10,000 units, we produce 8,500. We are at an 85% capacity utilization rate. This is really important for businesses that have high fixed costs, especially. If there are high fixed costs, we know that we have to pay these regardless if we are producing or if there's any output. Because of that, those high fixed costs, we want to make sure we have seats filled. Think about airlines. They will oftentimes overbook flights by taking into account that they believe some people will cancel or not show up on time to be on that airline. They have such high fixed costs to fly that they want to make sure that every seat is being fully utilized. They also works well with businesses with lower profit margins. If they have low profit margins, they're not making these huge margins on each sale, so they need to sell in large quantities or volume to increase that profit. Or high levels of break even, making sure that we're hitting that and going beyond it. So those are some really important things to notice. I want you to click on this and watch this video, COVID Flattening the Curve. We'll talk about this when you get back into class, but this is a really important video to understand why the shutdown happened. This is an Ohio speech, and we kept hearing flattening the curve. Really, a lot of people didn't understand why we had to to social distance. And it was really because of our hospitals. Our hospitals would not have had the capacity to handle an influx of patients. And so they were trying to give our hospitals time to get the right gear to protect the nurses, to protect the doctors, the right gear to make sure that they were treating patients properly, the right supplies that they needed because it happened so fast. So by having people social distance, it allowed for the hospitals to catch up. This was a capacity utilization issue 100% throughout the whole part of COVID. They knew there was going to be a spike in cases, but they knew they needed to give our hospitals time to be able to take care of people the right way, and they didn't want that to happen sooner. So take a few minutes to watch that video and then pause this, click on that, and then resume. All right, so there are drawbacks of high capacity utilization. You can see that there's probably, if it's a mass flow or even a batch situation where we might see an increased use of machinery, which increases maintenance costs, maybe increased breakdowns, potential delay of our output. It could also cause worker stress. Think about Adams equity theory. When we think about our inputs versus outputs, if we are putting in so much and it's constantly going, there can be some stress there. It also could connect to Herzberg's hygiene factors in terms of the working environment and the stress that might come along with that. There could be a decrease in quality. Typically, if you're working at capacity, you're trying to get things done, you're trying to get things done quickly, so there could be a potential decrease. For instance, if you have a restaurant that is completely full, you may have a situation where the serving time may be slower, which then decreases quality for the experience. Or if you have a plane that is completely filled or even overbooked, then the quality there can be reduced as well. You may see longer wait times, lower customer service. We can all relate to this possibly if you've ever been to the ER and you're waiting and waiting and waiting to get in. So keeping in mind that longer wait times could also upset customers and potentially could see some diseconomies of scale because as you see capacity being increased, we might start to see inefficiencies that could happen that actually raise our average or unit costs. This is a historical example. Please pause and read through this. This is a situation just to show in the last couple of years, capacity issues again with hospitals. All right, the defect rate. Defect rate takes the number of defective units and divides it by the total output and then times it by 100. So we're really looking at what percentage of our output is defective. What percentage of our output is defective? Substandard is a good term for that. The aim of total quality management or total quality culture is zero defects, so 0% defect rate. Again, not guaranteed, doesn't happen all the time using TQM, but that is the defect rate. This is not on your formula sheet. There are many disadvantages to having defective products. We know how wasteful it can be if something is not standard. You've already paid for the materials, for the labor, for the production of this product, and then it can be very wasteful. So connect that back to lean production and waste. Labor productivity. We are looking at typically individual workers, but the way it's worded, sometimes they will look at like a group of workers. So just make sure you're looking at the way it's worded. This is a economic indicator. I've clicked the Bureau of Labor Statistics so you can kind of see labor productivity for the United States. If you want to take a look at that, you are welcome to click on that link. We are looking at the total output divided by the total hours worked. Output, again, is interesting. It depends on what they give you. It could be units. If it's a manufacturing secondary sector situation, it could be sales. I mean, it really could be anything based on the situation. It works best though in secondary sector situations. So we are looking to compare the workers' efficiency. Again, we can do this by a single worker, an entire workforce, an entire state, an entire country. So when you click on that Bureau of Labor Statistics, you can see they talk about labor productivity rates and how that kind of indicates what's happening in an economy. Again, not given on your formula sheet. This is also just a map you can take a look at if you wanted to look at a little closer about labor productivity by state. I'm going to go back for a second. And very important that our workers are productive. I think we all understand that, as workers are more productive, there's higher output, there's potentially less waste, there is potentially higher sales, increased profitability. So when we look at that, very, very important. Okay, so where the productivity rate is different, this looks at the efficiency of production. It's not looking at the hours worked as opposed to looking at total output divided by total input and times 100. So this really measures the efficiency of production. So you think of input, output, like value added model. Input usually are our input costs for resources. So we have our human resources, we have or financial resources, physical resources, and then we look at our output. So we're really taking that value added model and we're looking at the total input and the total output and dividing those. And then again, with all of these industry standards should be used to benchmark these things. So again, how do we improve something like this? We increase our output, we decrease our input, if that's possible. This is one given on a formula sheet as well. The higher productivity rate, the better, more efficient workers are, or more efficient the way we're using all of our resources, not just the human resource. This also, these positives can also connect back to labor productivity as well. When we see higher productivity rates, we hopefully see economies of scale. We again might see those earnings, profits, wages. We might see increased competitiveness, growth of our company. So again, all of those bullets really can be positives of productivity rate and the last ratio, which was labor productivity. All right, capital productivity. Capital productivity is also known as working capital productivity. Working capital is going to be something you are going to want to always know. Working capital is calculated as current assets minus current liabilities. Current assets minus current liabilities. We typically don't just give you current assets and current liabilities. Please jot those down right now in your notes from memory. What you can remember, what are our three current assets that we use on our balance sheet? What are our three current liabilities? All right, so then we take our sales revenue and we divide it by our working capital. Then working capital again being that formula below. So capital productivity, this will measure how efficient our working capital is at making sales. All right, so is our working capital helping increase sales? Higher result is ideal. Again, benchmark with industry standards. This is one of those things I can't give you a good number, but benchmark within industries. This one is also not given on the formula sheet. Finally, operating leverage. Operating leverage looks really scary. Please take notes as I go through this. This is not as bad as it looks because it really takes unit contribution into account. And if you know unit contribution, we can make this a lot more simple. So if you look at the numerator and you look at what's in parentheses, we are looking at price times variable costs per unit, aka average variable costs. Price minus average variable cost is simply unit contribution. That is necessary to understand and know. Price minus average variable cost, unit contribution. You take that times the quantity sold, that gives you total contribution. We study this when we do the break-even chapter. We also study this throughout additional chapters throughout the course, including an additional pricing strategy we'll talk about down the road. And so when we look at this, we take our unit contribution times quantity gives us our total contribution. If you look below, take a minute to look at that denominator and see how it's different. There's only one difference in that denominator. It's total contribution again, minus fixed cost, minus fixed cost. Okay, so we're really measuring the value of our fixed versus variable costs, what percentage of fixed versus variable. And so we are really looking at how much of our total costs are made up of fixed costs and variable costs and how highly leveraged we are. That's kind of the term we use. Think of break-even formula. The break-even formula is very, very similar to a lot of this. So this is a lot of connections to break-even. When we look at this, you can please click on this. Take a few minutes to click on this and read about this further to learn more about it. So you should pause your video now and you should read what is in this area. So what happens when we have a high operating leverage? That shows that we have high fixed costs in relation to variable costs. And so that can be riskier. You're looking at those businesses that have those high fixed costs that really hope to have that high capacity utilization rate that we talked about earlier. When you have a low operating leverage, or a business that tends to have more variable costs that are high with lower fixed costs. So that's kind of what that means. Telling you what high or low is, again, is going to be different based on industries and the type of business they are. Like a service-based business versus a secondary sector manufacturing are going to have very, very different operating leverages. It is risky again when you're highly leveraged. That's what we say. That's another term you can use in disadvantages as you are looking at certain situations of high capacity utilization rates. If they are highly leveraged, we need to make sure we are connecting to making sure that they are at or as close to productive capacity as possible. So again, another term that you can use in terms of AO2s and AO3s is highly leveraged. All right, our final objective is looking at make or buy decisions. This is pretty intuitive and pretty simple. This is not on the formula sheet, but all of you at this point of your IB business careers should be able to do this. This is insourcing versus outsourcing. So we are now a business that is going to decide if we want to make something on our own or if we want to subcontract it and buy it from a supplier. This is a quantitative assessment only. So it ignores some qualitative factors, which we'll talk about. All right, the cost to buy from a supplier is simply the price minus the price times the quantity that you are looking to buy. The selling price that the supplier is selling it to you times the quantity you need. The cost to make is going to be fixed costs plus our variable costs per unit times quantity. So variable cost per unit, or average variable cost times quantity. So let's take a look at an example. We have a situation where a business is deciding between buying 1,000 benches. My suppliers could offer it to us for $20 per unit. But we also have capacity to produce these benches with our direct costs or variable costs at $13 per bench, allocated fixed cost 5,000. Quantitatively only, like on financial grounds only, should the business make or buy the benches. So pause the video. What should the business do based solely on numbers? And then jot down a few other factors that may be taken into consideration when deciding to make or buy. All right, so checking your work. Cost to buy would be 20,000. We take the $20 selling price times 1,000 units I need. The cost to make is going to be our $5,000 fixed cost plus our $13 per unit variable cost, or direct cost as it's called as well, times our 1,000 units. So it's 18,000. It makes financial sense to make it on our own with that savings of 2,000. However, this is only a quantitative analysis. There are definitely qualitative factors we need to consider. Is this our core competency? Is this what makes our value added, as we talked about in the outsourcing lesson in 5.4? Will I be able to make these benches at the quality that maybe my supplier could? Is my supplier reliable? Do I have a supplier that I have a good relationship with that could do this, get these to me shipped on time, done in a timely fashion with that relationship? So those are just some examples of qualitative factors that you would consider. Okay, so our objectives for this chapter for today's lesson would be you have to be able to calculate all of these, but you also have to be able to understand what they mean to the AO2 level and analyze situations based on these numbers. Again, not everyone is going to be on your formula sheet, unfortunately. The cost to make or buy is very intuitive. Defect rate, pretty intuitive. Capital productivity, you have to think about working capital. Operating leverage, you really want to make sure you're working and thinking through unit contribution, total contribution as you think about that and how that works. So that is today's lesson. We will practice all of this upon your return. Thank you so much and have a good day as I try to stop this. There we go.